In this video we will continue working through problem 328 in the book. Last video we had started working through this problem. It's a job order costing problem, and we were in the process of making journal entries for each of these transactions A through M. And we had gotten through transaction letter G. So let's continue on. In part H here, it says other manufacturing overhead costs were incurred for $17,000, and then it wants us to credit accounts payable. So this is probably the easiest of the journal entries. It basically tells you what to do. So we're going to be debiting manufacturing overhead control. Whoops. Manufacturing overhead control, and we're going to credit accounts payable. And you might wonder what are these other things that are overhead? These other things that are manufacturing costs, but they're not direct materials or direct labor. Well, there could be many things, right? One of them could be, say, the lease payment on the factory they have to make every month. Say the company doesn't own the factory that they make the props in. They lease the building, and they have to pay, a monthly lease, just like you have to pay your apartment rent every month. So that amount would be manufacturing overhead. And there could be many other examples that you could imagine. So let's go up here and fill in the appropriate accounts. And then we want to credit accounts payable, which was up here. Now, for part I, it says that the company applied manufacturing overhead to production. And it says that overhead is applied on the basis of direct labor cost. This is where we have to go up here and use this information. The company's predetermined overhead rate for the year, obviously the word predetermined means that the rate was decided as of the beginning of the year. And it's based on a formula that estimates, as of the beginning of the year, they estimated that during the year they would incur $80,000 in manufacturing overhead. And they estimated that the amount of money that they would pay their people who directly work on the product, the direct labor dollars, would be $100,000. And they feel that direct labor dollars is the best measure or cost driver for overhead. That whenever direct labor dollars goes up, overhead tends to go up in a similar way. And so that's their cost driver. And so the predetermined overhead rate would just be 80,000 divided by 100,000. And we're going to need that here because we want to know how much overhead was applied. What dollar amount of overhead was applied to production? Or another way to say it is what did they estimate manufacturing overhead would be what did they estimate that they would apply to production this year for manufacturing overhead, given the actual number or the actual level of the cost driver, given the actual labor dollars that they paid their people. So we use a formula here that the amount of overhead that they estimated, or applied overhead, the amount of overhead that they applied, they estimated that $80,000 of overhead would be incurred during the year. But the applied is based on their POHR multiplied by the actual level of the cost driver. So as soon as they know the actual level of their cost driver, in this case the actual direct labor dollars spent, then they can immediately apply overhead to production. Even if there's still some other things left in terms of actual overhead. I'll explain here in just a sec a little bit better. So their POHR is 80,000 over 100,000. Estimated overhead in the numerator, estimated level of the cost driver in the denominator. And we multiply by the actual level of the cost driver. The cost driver is direct labor dollars. How many direct labor dollars were spent this year? If we go up here to part, where was it? C, we see that right here, these are the direct labor dollars. And to illustrate this even better, if we go back to part C, it says payroll costs incurred and paid. direct labor, 120,000. That went right into work in process. So the actual level of the cost driver for the year is $120,000. And so dollars over dollars is just unitless times dollars, and we have dollars as our units, which is what we want. 0.8 times 120,000. So if we try that on the calculator, and I should be able to do that in my head, but $96,000 is what we apply for overhead. When you apply overhead, the journal entry is, add another page here, you're going to debit work in process. The only time you debit work in process is for direct labor costs, direct materials costs, and applied overhead. It's only 3 debits. And it's 96,000. And we're going to credit the manufacturing overhead control account. Why do you credit this account? There's not a real intuitive reason for why. You just have to memorize that when you apply overhead, you credit the manufacturing overhead control account. It's a holding account. It's a control account. We're going to credit that, and then work in process we're going to debit, and we're part I here. Where is it? Here we go. So you might wonder, why do we care about applied overhead? Why not just actual overhead? Since it looks like here that we're applying it at the very end of the year anyway. Well, it's shown as we are. It's shown like we are applying it at the end of the year because it's the last thing that happened here. But in fact, we can apply overhead. Remember, we can apply overhead as soon as we know the actual level of the cost driver, the actual direct labor dollars. And the actual direct labor dollars is often known before several of these things are even known, right? Like what we spent for the rent payment for the factory. We might do that at the end, the end of the year, and we might apply overhead before that because our direct labor is already paid, for example. And so we might actually know this number right here, this number 96,000, before some of the actual stuff was incurred. And often we do know that number before some of the actual overhead was actually incurred. And so it's useful then to have an estimate for what the overhead would be for the year, and we have this estimate as soon as possible. Because if you think about making a budget for the next year, it's kind of helpful to know what your previous year's results were, or at least have an estimate of what the previous year's results were. And oftentimes companies have to prepare budgets in advance. 2 months in advance of the next year, they need to prepare a budget. But this year is not over yet. But even if it's not over, we can still have an estimate here of the overhead that was incurred during the year. And that's the reason why there's this applied overhead, and we have this manufacturing overhead control account. Now, we applied 96,000, but we see the actual overhead is over here on the debit side of the account, the sum of all these numbers. And so often there will be a difference between actual overhead and applied overhead. Obviously, actual overhead is what matters in terms of financial reporting, in terms of costs that go to the income statement in the form of cost of goods sold. Our cost of goods sold has to be reported at the right value, or at historical cost. It has to be reported at the right value. And if we use this number, cost of goods sold will be a function of work in process, any cost that passed through work in process, finished goods, and or raw materials. And one of those costs that passes through work in process is manufacturing overhead. And so if we use this number for the manufacturing overhead part that passes through work in process, then cost of goods sold could be over or understated, right? Because this is just an estimate. It's the applied number. We want cost of goods sold to reflect the actual overhead. And so we're going to have to make an adjustment in this account so that happens. But we'll see that here in just a sec. So let's go to the next next one. So in part J, it says movie props that cost $310,000 to produce according to their job cost sheets were completed. So whenever we complete an item, the item moves out of work in process and moves into finished goods, right? Moves on, we put it on the shelf. And the costs that were incurred to get that item completed also have to move. And so there were 310,000 of those, and those costs have to go into finished goods. So we debit the finished goods inventory asset to make it go up by 310,000, and they got to come out of work in process because no longer these movie props are no longer in process; they're done. So we'll go record these. $310 there, and $310 there. Now let's move on to the next one. Sales for the year totaled $450,000, and all sales were on account. So that means that we sold goods to customers that were worth $450,000, but we weren't paid yet. But we have an account receivable, which means a promise that we are going to be paid by those customers. It's an asset. So we'll be debiting accounts receivable for $450,000, and we'll credit sales revenue for $450,000. But along with every sales revenue entry, whenever you make a sale, you make a sales revenue entry, and you also make an entry to reflect the cost of goods sold. So it says of those goods that we sold, it cost us $300,000 to produce them. And so we would be debiting cost of goods sold expense for $300,000, and since we got rid of the goods, we have to remove them from our inventory. So we credit finished goods inventory $300,000. So this is where those costs that were assets, they passed through raw materials, work in process, they were put into finished goods with this journal entry, and now once we sell those goods, the costs related to those goods, those costs that we incurred to get those goods to the point to be sold, and once they're sold, we got to recognize that, and we got to transfer those costs from assets to expenses in the form of cost of goods sold expense. This is what I was saying at the very beginning of this, at the beginning of part 1 of this video. And of course, we make the related sales entry. Debit accounts receivable for $450,000. Credit sales revenue. It cost us $300,000 to make the goods, and we sold them for $450,000. So we made $150,000 profit on these goods. So we can record these journal entries in the accounts. So accounts receivable, $450,000, and then sales revenue. Then I don't think we have an account for sales revenue. We need to create that right now. Revenue accounts have a normal credit balance, so we put that there. And then cost of goods sold expense and finished goods inventory. Cost of goods sold is an expense, so it has a normal debit balance. And then finished goods is $300,000 credit. We need to go up here and do that. So let's move on to the next one. Collections on accounts from customers, $445,000. They owe us $450,000, but this year we only collected $445 of that $450. and hopefully in the next year we collect the other $5,000, or maybe we don't and we have to write off the account. But to journalize the collections, obviously we debit cash for $445,000. So cash asset goes up, and the accounts receivable asset has to go down because we no longer are going to receive $450,000 or $445,000 in this case from these customers because they just paid us. So we go up here and debit cash for $445,000, and we credit accounts receivable for $445,000. And then the final one, payments on accounts to suppliers, or payments on account to suppliers. This is where we pay off our accounts. So we're going to reduce the liability accounts payable by $150,000. We no longer have $150,000 of this accounts payable liability because we just paid it off. So we reduced the liability by debiting the account. How do we get rid of the liability? Well, we have to get rid of cash. So we reduce the cash asset by $150,000 with a credit to that account. Oops. Make sure we get it right here. And accounts payable was $150,000 debit, and it's part M. Now, we've finished all the entries here, and it does say though for part 2 we still have to determine the ending balance for each T account. So let's do that. For each T account we just determine the ending balance. So for cash we're going to have 15 plus 445 minus 225 plus 150. So 15 plus 445 minus the sum of 225 and 150. So there's an $85,000 debit balance at the end for cash. And you just repeat this for all the T accounts. For accounts receivable, it's 40 plus 450 minus 445. And so forth. Raw materials, 25 plus 80 minus 90. Work in process, 30 plus 85 plus 120 plus 96 minus 310, 21,000. Finished goods, 45 plus 310 minus 300, 55. Notice that the inventory accounts at the end of the year often will have a balance in them. I mean, we still might have raw materials sitting in the storeroom that we haven't used yet, that we haven't put into a work in process. So this would be the dollar amount of those sitting there, right here. We could have goods at the end of the year that aren't done yet. They're just in work in process, and all the costs that have been incurred to get those goods to that point be sitting here. And then we could have goods sitting on the shelf that haven't been sold yet, and all the costs that were incurred to get those goods to that point are sitting right there. It's only when we sell the goods and they are removed from the shelf, then we can transfer. Then we can credit finished goods and debit cost of goods. What am I trying to say? Cost of goods sold expense. So, prepaid insurance, looks like there's 200. Buildings and equipment, we didn't make any entries in that account, so it started at 500,000 and it's still 500,000. Accumulated depreciation has a $240,000 balance. So the book value, the net book value of the buildings and equipment would be the $500,000 historical cost minus the $240,000 in accumulated depreciation, or $260,000. If we were to report on the balance sheet, you report plant assets at their historical costs less the balance and accumulated depreciation. Accounts payable here, 75 and 80 and 12 and 40 and 17 minus 150. Leaves 74,000. Common stock we didn't do anything with. Retained earnings. Retained earnings is different, right? Retained earnings, there's a formula if you remember from financial accounting. Beginning retained earnings plus dividends minus net income for the year equals ending retained earnings. It didn't say anything about dividends, so dividends in this one are 0. The beginning is 125. And we don't know what income is yet. So the income is going to be sitting right here whenever we can figure it out. We'll figure it out here in a minute. So we'll take that plus the dividends, which is 0, minus the net income, and we'll get our ending balance. Put net income here. And then we'll get our ending retained earnings. We'll do that here in a sec. And then, let's see, are there any other ones? Oh, the manufacturing overhead control, this is a key one. If it has 0 as a balance, then we don't have to do anything. But often it won't, because the actual overhead will not equal the overhead that you applied. If you add up the actual overhead, 5 and 30 and 12 and 25 and 4 and 17, you end up getting 93,000. And then we put a $96,000 credit over here. So the balance in the account as of the end of the year is $3,000. Now I'm going to, excuse me, I'm going to move this up so we can have a little more room for this. So there's $3,000 sitting there in that account at the end of the year. Well, we can't leave it like that. So we're going to do something about that here in a little bit. Salaries expense, 75,000 is the end. Depreciation expense, 5,000. I mean, technically these expense accounts, you have to close them out to give them a 0 balance at the end of the year. But before we do that, we have the balances there. We won't close these out in this problem. Shipping expense. All right, so I think that's it. We've determined the ending balance in every account. So now it's time for part 3. Now, it says, was manufacturing overhead under or over applied for the year? And then after you've determined that, assume that the company allocates any overhead balance between the WIP, finished goods, and cost of goods sold accounts. Prepare a journal entry to show the allocation. All right. If you go back to the manufacturing overhead control account, you can see that there was 3,000 more applied than actual. That means that overhead for the year is over applied. We applied more than what we should have. Actual overhead was 93,000. Applied overhead is 96,000. So we've applied 3,000 more than we should have. We have to fix that. We've put 3,000 too much into this account. We're going to have to debit this account for 3,000 to make the balance at the end 0. Balance in the manufacturing overhead control account has to be 0 at the end of the period. So we're going to have to debit the account for 3,000. So the answer here is 3,000 over applied. And then we have to fix that. So we have to debit manufacturing overhead control for 3,000. And then what do we credit? Well, there are two ways to fix the ending balance in the manufacturing overhead control account. You can either close it all out to cost of goods sold. That's one way. Cost of goods sold expense. And that would be the journal entry if it's over applied. If it's under applied, then you just flip these. Right? Or let's just work with this example right now, over applied. Or you can this is the quickest way, but it's not the most accurate. If we do that way, what we're saying is we think that all of this 3,000 that if we go back here, remember, whenever we apply overhead, what do? We debit work in process for the amount that was applied. If we go back, where is this? Part J, I believe, or I. Oh, yeah, I is what it was. Yeah, what do? We debit work in process, and we credit manufacturing overhead control. That's when we apply overhead. And so if at the end of the period, the manufacturing overhead control account has a $3,000 credit balance, that means we've applied $3,000 too much. If we close that $3,000 out, all the cost of goods sold, we make this journal entry right here, the first way. If we close it all out to cost of goods sold, in effect what we're saying is that all $3,000 of this has made it all the way, got all the way through work in process and was transferred to finished goods, and the goods were sold and it's already in cost of goods sold. But it's not likely that that happened. In fact, part of the $3,000 that we originally put into work in process, for applied overhead, part of it's probably at the end of the year still left in work in process. Some of it, right? But some of it, if the goods that overhead was attached to are finished and have gone to finished goods, then of course that part of the $3,000 of the manufacturing overhead cost went with it, and part of it still might be left in finished goods. And then if those goods have been sold, then the part that's attached to it would have been transferred to cost of goods sold. So in effect, part of the $3,000 is still in WIP, part of it's in finished goods, and part of it's in cost of goods sold. And recognizing this would mean that you would have to make a credit journal entry here for WIP, finished goods, and cost of goods sold, and not just close all of the $3,000 out to cost of goods sold. So this is the quickest way, but it's not the most accurate. So this is the first way you can do it. And the second way would be, as I said, you would debit the manufacturing overhead control account for $3,000. Actually, if you're doing it this way, you're just assuming it all is in cost of goods sold. But if you do it this way, where you credit cost of goods sold expense, credit WIP, and credit finished goods. Actually, I should probably do it in this order. It doesn't matter what order, obviously, but I'm going to do it like this because generally, if your company is efficient, most of the $3,000 that you applied should be in cost of goods sold, because most of those goods should have already made it through WIP and then finished goods and then should have been sold. And then a smaller proportion should still be left in finished goods, and even a smaller proportion should still be left in WIP. And so all you have to do is figure out what numbers go here. We know the sum of these has to be 3,000. And this is where you use this allocation procedure, which is you just look at the ending balance in the WIP account. Oops. You look at the ending balance in the WIP account, the finished goods account, and the cost of goods sold account. And then you choose weights, 3 weights, one for WIP, one for finished goods, and one for cost of goods sold, that we're going to apply to this 3,000. And we choose their weights in proportion to how much of the total balance is still left in WIP, finished goods, and cost of goods sold, respectively. So the WIP ending balance is, go up here to WIP, you see that the ending balance is 21. Finished goods, 55,000. And then cost of goods sold, I believe, was 300,000. Where was it? Yeah, right here, 300,000. So 21, 55, and 300. The total then would be what? 355 and 21, 76, 376. And so then we just choose weights. For WIP, the weight would be 21 over 376. 21,000 over 376,000. For finished goods, it would be 55 over 376. For cost of goods sold, it would be 300 over 376. When we do this, what are we implicitly assuming? We're assuming that, for example, look at cost of goods sold. There's $300,000 in the account at the end. That represents, if we calculate the 300 over 376, that represents 79.79% 79.79% of the total balance in these three accounts. 79.79%, or effectively 80% of it, is in cost of goods sold. And by applying that weight to their $3,000, we're saying that approximately 80% of that $3,000 of over-applied overhead has been transferred all the way through and gone into cost of goods sold. And so we should close out 80% of the $3,000 to cost of goods sold. Now, whether that assumption is right or not, we don't know, but we have to do it. We have to assume something whenever we're trying to decide how much of the $3,000 should go to each of these accounts respectively. And that seems to be a reasonable assumption. If cost of goods sold has a huge balance in it compared to the other two accounts, then it's likely that a bigger proportion of the $3,000 that we over-applied has already made it all the way through to cost of goods sold. So that's the justification for the assumption. So we need the weights on the other ones. 55 divided by 376, 14.63%, and then 21 over 376 would be 5.59%. Now all we have to do is take these weights and multiply them by their respective by 3,000. And actually, let's not do it to two decimal places. Let's just do it to one. Otherwise, it's going to be too. It might get too messy. So then all we need to do then is for the cost of goods sold, we take 3,000 times 0.798. That would be the credit to that account. And then 3,000 times 0.146. And then 3,000 times 0.056. And that would be the journal entry to close out this over-applied overhead. So make sure you understand how to do it. This is the second way. The easiest way is just close it all out to cost of goods sold, and the most accurate way is to do it this way. Notice that cost of goods sold still gets the majority of the 3,000 because the ending balance in cost of goods sold should be, much bigger than finished goods, and then the finished goods one should be bigger than WIP. It should be like this. And if that's the case, then you're going to see that this is going to be the biggest number whenever you do it the more accurate way. Alright, so what's next? Part 4 is we need to prepare an income statement for the year. Do not prepare a schedule of cost of goods manufactured. All of the information needed for the income statement is available in the T accounts. Alright, so let's do the income statement. We're going to start with sales revenue. And we know that for the year, sales revenue is $450,000. We can find that in the sales revenue T account here in part right here. Then we want to subtract cost of goods sold. But careful, cost of goods sold, it was $300,000, but then we made this journal entry right here. Which I forgot to. I need to go record these numbers in the T accounts respectively. I already debited the manufacturing overhead control for $3,000 to close it out, but I forgot to go record these in the account. So $23.94 be here. The actual cost of goods sold for the year, the balance would be $297,606. And so that would be what we would put next here. . And then sales minus cost of goods sold is gross profit or gross margin. And that is what am I doing here? 450,000 minus 297,606, 152,394 gross margin. And then we need to subtract all of our selling, general, and administrative expenses. And obviously this is just a partial income statement. We're just going to get the net operating income. But any non-operating revenues and expenses, which it didn't tell us about any of those, we're not including that. Like if the company buys a bond, it basically means that it has to pay interest every 6 months or every month. Then that interest expense, that's an expense that's not related to their operations, right? So any non-operating revenue and expense we won't show here, but they didn't tell us about any of that information. So we just have the operating revenues minus those manufacturing expenses, those costs that went through WIP, finished goods, and raw materials. And once the goods were sold, they were transferred to cost of goods sold expense. So those costs that were once assets that have become expenses, minus those costs that have always been expenses. All of this stuff that we're going to... So that is all of our revenues minus all of our expenses. The SG&A stuff would include... now we just have to go look at the T accounts. Let's see. Shipping expense, insurance expense, depreciation expense. Let's put those. What else? Is there anything else? Let's see. Salaries expense. And I believe that's it. Now I should probably do this here in a little bit better way. Let's put this over here. Let's underline this, get a total, and we'll put that total right here. And then we just take that, subtract it from the 152,394 to get our net operating income. You don't just want to say net income, because again, we haven't subtracted those operating revenues and expenses. They haven't told us about any, which doesn't necessarily mean there aren't any in this particular. In these types of, in this context, you would always just say net operating income. So 40 plus 5 plus 800 plus 75,000, 120,800. And then you subtract 152,394 minus 120,800, and you get 31,594 would be the net operating income for the year. And so we finished part 4. Now we finished everything that this problem wanted, but we can go ahead and do one other thing here. We can take our 31,594 net operating income here. Assuming that was the net income and there weren't any other revenues or expenses, we can go back up here to retained earnings. Where is retained earnings? Right here. And we can calculate the ending balance in retained earnings. Remember, it's the beginning balance plus dividends, which were 0, minus the net income, 31,594, equals the ending retained earnings. $93,406. And then there's one other thing that we, so retained earnings as of the end of the year has a $93,406 balance. Oh, what am I doing here? I have said something wrong. If you guys are confused at this point, it's because I have said this wrong. The retained earnings equation is retained earnings minus dividends. We pay dividends out of retained earnings. Dividends decrease retained earnings. Plus net income. Net income increases retained earnings. So I've just done the math wrong. Yikes. Sorry if I confused you, I apologize. 31,594. This is actually a debit on this side. This is net income. Yeah, so we start with 125,000 as of the beginning of the year in retained earnings. And if we earn 31,594 net income for the year, then our ending balance has got to be greater than what it started with. So 125 plus 31,594, or 156,594. There we go. I realized that what I was saying didn't make sense. Why would retained earnings be less than what it was at the beginning of the year if we had positive income for the year? So it shouldn't. It should be greater. It started here and then it went to here at the end of the year. So that pretty much wraps it up. There is one other thing here that I haven't done, and I remember now in this problem. It doesn't ask us to do it, but just to technically be correct, we credited finished goods right here for 438, and we credited WIP for 168. We need to go back and do that up here in the T accounts. Come on, finished goods. Where is it? Yeah, technically we credited finished goods for, what was it again? I've already forgotten. For 438, and we credited WIP for 168. So if we go back up here, credit of 438, and then WIP was 168 credit. So the ending balance in each of these accounts after that, 55,000 minus 438, 54,562, and then in finished goods it's 21,000 minus 168, or 20,832. Sorry, I should just erase this. It started at 21, or it was 21, and that's what we used to calculate this 168 thing. But then once we, get rid of the 168, then it's 2832, and then same thing over here on the finished goods side. So hopefully that makes sense, and this concludes problem 328 in the book, Job Order Costing.